It is time for a wealth tax in America.
And, we have ideas now that we talk about that we just weren't talking about even a year ago. A 2-cent wealth tax and universal child care that could be real. We could make it happen.
So if you're asking me, do I think we should demand that the wealthy start paying the wealthiest, top 1/10 of 1%, start paying their fair share of taxes so we can create a nation and a government that works for all of us? Yes, that's exactly what I believe.
I was one of the first people on this stage to propose a wealth tax.
So what is a wealth tax, and how does it differ from your income tax? In most taxes, there's usually some sort of money being transferred. With income taxes, you get paid, and a certain amount of your paycheck goes to the government. Likewise, when you buy a cup of coffee in the morning, there's a sales tax added to that, and that goes to the government.
So the wealth tax is a tax on somebody's net worth, and we have a similar type tax at the federal level called the estate tax, where when someone passes away, if the value of their estate is over a certain threshold, their estate is valued and that estate will be taxed.
Now, it's important to mention that only certain people will be subject to a wealth tax. Under the plan outlined by Vermont Senator Bernie Sanders, the wealth tax will only be imposed on individuals with at least $32 million in net worth. Likewise, former presidential candidate and current Massachusetts Senator Elizabeth Warren released a similar plan, though Warren's plan would have only taxed people with over $50 million in net worth. And Democrats aren't the only ones in this race who have voiced support for a wealth tax. In 1999, President Donald Trump, then considering a run for the White House as a member of the Reform Party, called for a wealth tax, though it differed both in its implementation and its desired outcome. Trump called for a one-time 14.5% wealth tax on net worth over $10 million to pay down the national debt. Unlike this plan, the proposals from Senator Sanders and Senator Warren impact fewer people, have a far lower tax rate even for the largest net worth, and are annual, not a one-time deal. Since this time, however, Donald Trump appears to have changed his mind on the wealth tax and has criticized the plan put forward by Senator Warren. Now, this doesn't mean all Democratic candidates support a wealth tax. Former Vice President Joe Biden released a tax plan with no reference to a wealth tax, instead focusing on taxing capital gains as normal income. But wait a second, what are capital gains?
The biggest difference between a capital gains tax and a wealth tax is that for a capital gain tax to be imposed, an individual has to have sold something.
The wealth tax has pretty substantial support from both parties. A Reuters poll from January showed that nearly 64% of respondents either strongly or somewhat agree with a wealth tax. The idea was more popular among Democrats, with 77% of Democrats saying they supported it, but even a majority of Republicans, 53%, saying they support the idea. However, only a handful of countries across the globe still have it.
A lot of it's driven by the fact that there are concerns about driving businesses away. There's a great historical example in the United States that Cleveland sought to institute a wealth tax, and which caused the Rockefellers to move all of their properties and businesses to Pennsylvania.
Today, only 3 countries have a wealth tax: Norway, Spain, and Switzerland. France had a form of the wealth tax before Emmanuel Macron ended it. One of the architects of Elizabeth Warren's tax plan, economist Gabriel Zucman, told NPR in 2019 that Warren's plan tried to correct some of the issues European countries like France faced. The United States can tax citizens no matter where they live, meaning they can still tax people on their net worth even if they live in another country that doesn't have a wealth tax. This means that the only way the ultra-wealthy can avoid paying the wealth tax is by renouncing their U.S. citizenship, and even if they do that, they still have to pay what the Washington Post called a, quote, exit tax. This means that the wealthy who choose to renounce their U.S. citizenship have to pay a 40% tax on their net worth over $50 million. Now, there are also some logistical issues in actually enforcing a wealth tax. Since most people don't keep their assets exclusively in cash, The wealth tax would require the IRS to appraise the value of goods that could go up or down in value year after year, like artwork, meaning that they continually have to appraise them. Without dramatically increasing the IRS's budget, this could be a major hurdle for the federal government's enforcement of a wealth tax. And another major hurdle for the wealth tax is its constitutionality. When Senator Warren first outlined the plan, she released letters from prominent constitutional and tax law specialists saying that her plan is constitutional. Even still, any wealth tax is likely to be challenged in the courts, which presents a unique challenge to the plan given the current layout of the 9-person Supreme Court. Ultimately, it's hard to say how much a wealth tax could potentially raise until it actually happens. The Sanders campaign says their tax could raise over $4 trillion over the next decade, which would certainly help pay for his plans, including Medicare for All. So there we have it. A wealth tax isn't like the income tax, and while it could generate a substantial amount of money, it's not without its risks and hurdles. For TriStatehomepage.com, I'm Ryan Wittry.